Hello there. So this is for the subject monetary policy and central banking. The topic of this particular video is fiscal policy. Okay, so we have here an article from investopedia.com. Let's begin with the definition. So fiscal policy, the means by which a government adjusts its spending levels and tax rates to monitor and influence a nation's economy. Essentially, the influence is of course, to support economic growth. But when it comes to, inflation monitoring and control, it's on the monetary policy side, okay? With regards to fiscal policy, it's more on the spending levels of the government and the tax rates, tax laws being implemented or imposed, and sometimes would include proposed bills, tax bills, okay? It is the sister strategy to monetary policy through which a central bank influences a nation's money supply. These two policies are used in various combinations to direct a country's economic goals. Okay. Here's a look at how a fiscal policy works, how it must be monitored, and how its implementation may affect different people in an economy. Okay. Some sort of history. Before the Great Depression, which lasted from October 29, 1929, to the onset of America's entry into World War II, the government's approach to the economy was laissez-faire. Okay. Following World War II, it was determined that the government had to take proactive role in the economy to regulate unemployment, business cycles, inflation, and the cost of money. Essentially, the cost of money is the cost of borrowing, interest rates. By using a mix of monetary and fiscal policies, depending on the political orientations and the philosophies of those in power at a particular time, then one policy may dominate over another. But usually they go hand in hand. Governments can control economic phenomena. Key takeaways. Fiscal policy is the means by which a government adjusts its spending levels and tax rates to monitor and influence a nation's economy. That's the main point of the article. It is the sister strategy to monetary policy, through which the central bank influences a nation's money supply. So a reiteration of what monetary policy is about. And then using a mix of monetary policy and fiscal policy, governments can control economic phenomena, essentially economic activities, growth and development. How fiscal policy works. Fiscal policy is based on the theories of British economist John Maynard Keynes, and also known as Keynesian economics. This theory basically states that governments can influence macroeconomic productivity levels by increasing or decreasing tax levels and public spending. Okay. This influence in turn curbs inflation, generally considered to be healthy between 2 and 3%, increases employment, and maintains a healthy value of money, purchasing power, the valuation of money. That would also include the exchange rate. Fiscal policy plays a very important role in managing a country's economy. For example, in 2012, many worried that the fiscal cliff, a simultaneous increase in tax rates and cuts in government spending, set to occur in January 2013, would send the U.S. economy back into recession. Okay. Increase in tax rates, so the money goes from the market to the government, and then the government has government cuts, so it's not going to spend money, so the money would not return to the market. So there's a limited supply of money, so that could induce recession. Okay. The U.S. Congress avoided this problem by passing the American Taxpayer Relief Act of 2012. Okay, so essentially they return the money into the public or into the market by providing taxpayer relief. All right. The Balancing Act. So the idea is to find a balance between tax rates and public spending. So for example, stimulating a stagnant economy by increasing spending or lowering taxes, also known as expansionary fiscal policy, runs the risk of causing inflation to rise. Even in monetary policy, if the policy or if the implemented policy would increase the money supply in the market, then it could lead to inflation. All right. This is because an increase in the amount of money in the economy, followed by an increase in consumer demand, can result in a decrease in the value of money, which is the purchasing power. Essentially, the amount of goods and services that you can purchase with a certain amount of money is lesser, right? Essentially, that's what purchasing power means. It would take more money to buy something that has not changed in value. So, for example, before you can buy a sack of rice for less than 1,000, but nowadays you need, 1,500 to almost 2,000 to buy one sack of rice. Okay, so there's a decrease, or there's a decrease in the purchasing power or the value of money. Moving on, let's say that an economy has slowed down, so recession. Unemployment levels are up. This is the current situation here in the Philippines, right? We're in recession. Unemployment levels are up because there are many businesses that have stopped operations. There are also many businesses that, have slowed down their operations. They're not operating at full capacity. Consumer spending is down because many people have, lost their jobs, so they don't have source of funds, source of money, so they're not spending. Essentially because they don't have money to spend, right? Businesses are not making substantial profits because of, the lockdowns. People are also, not spending their money. So the government may decide to fuel the economy's engine by decreasing taxation. There's to create lower corporate tax rates. And then, of course, previously during the train law, the tax rates for individuals have also been lowered. Okay, which gives consumers more spending money while increasing government spending in the form of buying services from the market. So if tax rates are lower, then, the people and the businesses would have more money to spend on their, whatever they want to spend on, right? And then, where are we? More spending money while increasing government spending in the form of buying services, such as building roads or schools. So we have the Build program. By paying for such services, the government creates jobs and wages that are in turn pumped into the economy. So pumping money into the economy or increasing the money supply by decreasing taxation and increasing government spending is also known as pump priming. So in the meantime, overall unemployment levels will fall, or employment levels will rise. With more money in the economy and less taxes to pay, consumer demand for goods and services increases. This in turn rekindles businesses and turns the cycle around from stagnant to active. Alright. So essentially, when you put more money into the economy or in the market, then that would stimulate economic activity, and stimulating economic activity would lead to economic growth. If, however, there are no reins on this process or, control, the increase in economic productivity can cross over a very fine line and lead to too much money in the market. That's why it's always a gradual process when the government and even when the central banks decide to increase the money supply. They do it in a gradual way, not abrupt, so that they could control the effect that it's having in the economy. This excess in supply decreases the value of money while pushing up prices, inflation, because of the increase in demand for consumer products. Hence, inflation exceeds the reasonable level or the acceptable level. For this reason, fine-tuning the economy through fiscal policy alone can be difficult, if not improbable, means to reach economic goals. That's why there's the monetary policy to counteract the effects. If not, I think they highlighted this statement. If not closely monitored, the line between a productive economy and one that is infected by inflation can be easily blurred. When the economy needs to be curbed. When inflation is too strong, high prices are too high, the economy may need a slowdown. In such a situation, a government can use fiscal policy to increase taxes, to suck money out of the economy. So, by paying more taxes, the money goes out from the market to the government. Fiscal policy could also dictate a decrease in government spending. Instead of releasing more money, they would stop the spending or slow down the spending so that the money would not get released into the market, and thereby decrease the money in circulation. Of course, the possible negative effects of such a policy in the long run could be a sluggish economy or a slowdown economy and high unemployment levels. Nonetheless, the process continues as the government uses its fiscal policy to fine-tune spending and taxation levels with the goal of evening out the business cycle. So it's really tricky, complicated, and kind of not an easy decision to make, increasing the growth of the economy, increasing the employment rate, or controlling the inflation. Because to increase the employment rate, there's a possibility of increasing inflation as well. Wait, it's already inflation. Oh, there's also the possibility of inflation as well. And so to curb the inflation, then you'd have to, curb the increase in employment rate. It's not an easy decision. Who does fiscal policy affect? So unfortunately, the effects of any fiscal policy are not the same for everyone, depending on the political orientations and goals of the policymakers. A tax cut could only affect the middle class or, the wealthy individuals as well, which is typically the largest economic group. In times of economic decline and rising taxation, it is the same group that may have to pay more taxes than the wealthier upper class. Normally, not very much affected the wealthy individuals, right? Similarly, when a government decides to adjust its spending, its policy may affect only a specific group of people, normally the lower class. A decision to build a new bridge, for example, will give work and more income to hundreds of construction workers. A decision to spend money on building a new space shuttle, on the other hand, benefits only a small, specialized pool of experts, which would not do much to increase aggregate employment levels, right? That said, the markets also react to fiscal policies. Stocks rose on December 21, 2017 for the first time in 3 days, following the passage of the Trump administration's $1.5 trillion U.S. tax bill, the Tax Cuts and Jobs Act. The Dow Jones Industrial Average gained 99 points or 0.4%, and S&P 500 index rose 0.25%. Nasdaq Composite Index was up 0.14%. So essentially, the passage of this act provided positive, what do you call that? Positive reactions, okay, in these different numbers, figures, measurements, okay. The tax overhaul is forecast to raise the federal deficit by hundreds of billions of dollars and perhaps as much as $2 trillion over the next 10 years. Okay. Raise the deficit. Okay. I think that's a bad one. Estimates vary depending on assumptions about how much economic growth the law will spur. The law cuts corporate tax rates permanently by creating a single corporate tax rate of 21% and repeals the corporate alternative minimum tax. Ooh, that's nice. The law also retains, this is good for the businesses, okay? The law also retains the current structure of 7 individual income tax brackets, but in most cases, it lowers the rates. The top rate falls from 39.6% to 37%, while the 33% bracket falls to 32%. 28% bracket to 24, 25 to 22, and the 15 to 12. Wow. Here in the Philippines, of course, 250,000 and below, if that's your income, then you are not taxable. You're not taxed. But if it's over 250,000, the rate applicable is 20%. Okay, and then there's 25, 30. I think 35 is the highest, or was it 32? Forgot. The lowest bracket remains at 10%, and the 35% bracket is also unchanged. The lowest and highest. These changes are set to expire after 2025. Okay. Bottom line, one of the biggest obstacles facing policymakers is deciding how much involvement the government should have in the economy. Indeed, there have been various degrees of interference by the government over the years. But for the most part, it is accepted that a degree of government involvement is necessary to sustain a vibrant economy. Essentially, that's, governance. That's what they're for. Okay, and they're also needed to help for the growth of the country, on which economic well-being of the population depends. Okay. Alright, so that's the overview of the fiscal policy. What's our understanding of it? Alright, so that's it for this one. Thanks and bye.